Scott. We've spent a lot of our career living in a GP LP world. We have great LP relationships with the private equity firms out there. We've also dipped our feet into and had some great success in the crowdfunding area. And we spent a lot of time building up our own private investor base. And that has really grown over the last few years. But as you look at the two strategies that we've outlined, multi-tenant light industrial and distressed office, where do you think we're going to go to capitalize those strategies?
So let's look at debt first. I mean, I think right now in these choppy waters, as a guy who was formerly a debt broker, there's guys who are paid to know exactly what's going on out there. So we're going to use debt brokers on every deal we have to find. It used to be, I said this back in 1998, it used to be you could find the best debt, and then in 1999, 2000, you were looking for some debt. We've kind of reverted to where it's not a plethora of debt anymore. It's very rifle shot. You got to find the right guys. And I think we're going to use the debt brokerage world to help us there. We talk to lenders all the time directly, but I think there's a lot that are on the sidelines, and you're never going to know exactly when they get back. And I think we're going to use our partners at the various debt brokers to help us there. On the equity side, what we're finding is, I just spent a week in New York. The family offices are really seeing blood in the water. They're not sure they're ready to act yet, but they're seeing opportunities start to come around. A lot of office buildings in New York are being discussed or are being converted into residential, which is a pretty expensive proposition, but the bases are getting so low that they're now viable. So I think the equity side of the transaction is going to be with our trusted partners, some of which are on the sidelines any given day, but most of which are very active. So I think it's going to look a lot like it did before. I just think the unlevered IRRs and the levered IRRs are, even in a higher rate environment, are still getting higher to meet their anticipated risk. And so you've got a series of things dipping down on prices, dipping down on what the bids are for the higher asks. So what we're looking at right now is using our debt brokers to help us with the debt, going out to our friends and family on the institutional side, and then the crowdfunding guys have been really beaten up over the last 6 months and are having a harder time filling the order. So I think it'll still be part of our strategy, but we'll be less dependent on that. And as we continue to grow the investor platform within Rising, I think that will help us buy some of these smaller MTLI deals and help us diversify our equity sources and what we're doing in our office assets.
Yeah, I think for better or for worse, I guess we'd love to say that we wouldn't consider a deal under $20 million because we're got this and that. Some of the best deals we find are under $20 million, and that's a unique set of investors that we've connected with. And I think for us, growing that platform on our side, I think we're going to find several deals over the next 12, 24 months that are just below where a private equity LP would be. And either crowdfunding is going to do it, or I really believe our investor platform will do it. And I just saw today another distribution on our Vegas deal, MTLI deal. So we've hit every quarter there. Those are good deals for people.
Totally agree. I think that it kind of flips on you when you go to the small deals. It's not the equity necessarily that's the problem; it's the debt. Because there's so few banks out there right now that are the regional banks that are active.
Yeah.
So on those $20 million deals, finding that $12, $13 million of debt is really going to be the highest hurdle, in my opinion.
Yeah, I agree with you.